Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to learn about risk in banking business, Chapter 9, Module B of Risk Management of Bank Financial Management course. Now, if we talk about risk from the management point of view, banking business may be grouped broadly into major heads such as banking books, trading book, and off balance sheet exposures. So we'll read all these three different kinds of exposures and how the risk is managed by the management. Let's first talk about the banking book. Now, the banking book includes all advances, deposits, and borrowings, which usually arises from commercial and retail banking operations. All assets and liabilities in banking book have the following characteristics. First, they are normally held until maturity. Accrual system of accounting is applied. They are not subjected to mark to market exercise. They attract capital charge on the credit risk and not on the market risk. So, if you have to talk about the trading book includes all the assets that are marketable. That is, they can be traded in the market. They are normally not held until maturity. Mark to market system is followed, and the difference between the market price and the book value is taken to the profit and loss account. The trading book mostly comprises of fixed income securities, equities, foreign exchange holdings, commodities, etc., held by the bank on its own account. Now, what do you mean by off balance sheet exposures? Off balance sheet exposures are contingent in nature, where bank issues guarantees committed or backup credit lines, letter of credit, etc. Now, banks face payment obligations contingent upon some event. Derivatives are off balance sheet market exposures. They may be swaps, futures, forward contract, foreign currency contracts, options, etc. So, off balance sheet exposure may become a fund based exposure based on the happening of the certain contingent event. Now, let's talk about banking risk. Now, from the above discussion, you can learn the major risk in the banking business. They are liquidity risk, interest rate risk, market risk, default or credit risk, and operational risk. Now, what do you mean by liquidity risk? Now, liquidity risk of banks arises mainly from funding of long term assets by short term liabilities, thereby making the liability subject to rollover or refinancing risk. Now, liquidity risk is the inability to obtain funds to meet cash flows obligation at a reasonable rate. Liquidity shortfall has to be met at times at cost which is more than planned or normal cost. At the extreme, banks may have to fail to fund the liquidity gap resulting in default, which has serious consequences. So, if you have to give a broader classification of liquidity risk, it can be divided into three different types: funding risk, time risk, and call risk. Now, funding risk arises from the need to replace net outflows due to unanticipated withdrawal or non renewal of deposits or premature closure of term deposits. If we talk about time risk, it arises from the need to compensate for non receipt of expected inflows of funds, that is, performing assets, turning into non performing assets or borrowers not repaying their installments. Call risk, the third type of risk, arises due to the crystallization of contingent liabilities since customers are not meeting their commitments on due dates. This may also arise when bank may not be able to undertake profitable business opportunities when it arises. Now let's talk about another type of risk which is called interest rate risk. Now, interest rate risk is the exposure of a bank's revenue to the adverse movement in interest rate. It refers to the potential adverse impact on net interest income or net interest margin or market value of equity caused by changes in market interest rates. Now, the risk of changes in the financial value of assets or liabilities because of fluctuations in interest rates. Now, interest rate risk can be viewed in two ways: its impact on the earnings of the bank or its impact on the economic value of the bank assets, liabilities, and off balance sheet positions. Now, what is gap or mismatch risk? A gap of mismatch risk arises from holding assets and liabilities and off balance sheet items with different principal amounts, maturity rates, or repricing dates, thereby creating exposure to unexpected changes in the level of market interest rate. Now, if we talk about basis risk, an example of basis risk would be to say in a rising interest rate scenario, the asset interest rate may rise in different magnitude than the interest rate on corresponding liability, creating variation in net interest income. Now, what is yield curve risk? Now, in a floating interest rate scenario, banks may price their assets and liabilities based on different benchmarks, that is, treasury bills yields, fixed deposit rates, call money rates, MIBOR, etc. In the case the bank uses two different instruments maturing at different time horizon for pricing their assets and liabilities, any non-parallel movement in yield curve would affect the net interest income. Now, what is embedded option risk? Now, significant changes in the market interest rate creates the source of risk to banks' profitability by encouraging prepayment of cash credit or demand loan term loans, an exercise of all call or put options on bonds, debentures, and or premature withdrawal of term deposit before the stated maturities. Now, what is reinvestment risk? Now, uncertainty with regard to interest rate at which the future cash flow could be reinvested is called in reinvestment risk. Net interest position risk: when banks have more earning assets than paying liabilities, interest rate risk arises when the market interest rates is adjusted downwards. Now let's talk about market risk. Now, market risk is the risk of adverse deviations of the mark to market value of the trading portfolio due to the market movements during the period of holding. This results from adverse movements of the market price of interest rate instruments, equities, commodities, and currencies. Market risk is also referred as price risk. Now, what do you mean by forex risk? Now, forex risk, also termed as exchange risk, is the risk that a bank may suffer losses as a result of adverse exchange rate movements during the period in which it has an open position, either spot or forward, or a combination of two. What is market liquidity risk? It arises when the bank is unable to conclude a large transaction in a particular instrument near the yield curve market price. Now, if we talk about default or credit risk, it is simply as the potential of the borrower or the counterparty failing to meet their obligation in accordance with the agreed terms. So, any customer who is not able to make the repayment on time is a credit risk. Counterparty risk, it is a variant of credit risk and it is related to non performance of the trading partners due to counterparty's refusal or inability to perform. So the other party has refused to make the payment. This is called counterparty risk. Country risk is also a type of credit risk where the non performance by the borrower arises due to the constraints or restrictions imposed by a country. So this can happen. Some countries may not be able to function properly because of any problem, internal security problem, or any problem. So this country risk may arise. Now let's see what is operational risk. Now, operational risk is the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. Strategic risk and reputation risk, though in nature of operational risk, are not covered under the definition of operational risk by BCBS. Now, what is transaction risk? Now, transaction risk is the risk arising from fraud, both internal and external, failed business processes, and inability to maintain business continuity and manage information. What is compliance risk? Now, compliance risk is the risk of legal or regulatory sanction, financial loss, or reputation loss that a bank may suffer as a result of its failure to comply with any or all of the applicable laws, regulations, codes of conduct, and standards of good practice. It is also integrity risk since a bank reputation is closely linked to its adherence to principles of integrity and fair dealing. Now, what is strategic risk? Strategic risk is the risk arising from the adverse business decisions, improper implementation of decisions, or lack of responsiveness of the industry. What is reputation risk? Reputation risk is the risk which arises from negative public opinion. This risk may expose the institutions to litigation, financial loss, or decline in consumer base. Now, let me ask you certain questions which I'm sure you'll be able to answer in the description box below. Question number one: financial risk is defined as. Question number two: strategic risk is a type of. Question number three: a bank funds its assets from a pool of composite liabilities. Apart from credit and operational risk, it faces. Okay. A branch sanctions 1 crore loan to a borrower. Which of the following risk the branch is taking? Last question. Premature payment of term loan will result in interest rate risk of type. I hope you'll be able to answer these questions. So, this is uh, a great value which you will receive after listening and going through this video. And if you have reached at the end of this video, be rest assured that you have reached a channel that will give you a similar treasure of knowledge, and that's a promise. So please subscribe and become a lifetime learner of our channel. Thank you.